The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody. This is Kathy with Premier Companies. Welcome to our Is Hybrid Life a Trick or a Treat? A special Halloween-ish type year, time frame of the year. I have with me Jay on the phone from One America. Good morning, Jay. How are you?
I am good, Kathy.
Great. I see a few more people trying to log in this morning, so if you want to give us another 60 seconds so we can start taking off and go into full detail mode here. But Jay, a lot of people keep on calling me and asking me and saying things that, is hybrid life a trick or a treat? What's going on with it? So is this real? Is it too good to be true? That's kind of why we put this together for everybody out there, is to realize it's like this is the real meaning of what a hybrid life insurance plan is. So if you hear it from other avenues and you're not sure if they understand what's going on, call Premier, call in and ask for a hybrid life marketer. We can actually help you understand what is real and what's not real about a hybrid life insurance plan. So Jay, if you want to go ahead and kick us off and get started, I would appreciate that.
Okay, absolutely, Kathy. I appreciate it, and thank you for having me on, and I want to thank all of you guys for taking time out of your day for this particular webinar. I was excited about it as well. The theme for Halloween, and is it a trick or treat? Because unfortunately, they're not all hybrid products are made the same. So many times we all get lumped in together when you hear the word hybrid, and people tend to think they all work the same, and they don't. So I'm excited to get rolling on this and dispel some of the hocus pocus that is out there. If you guys going along, just some housekeeping stuff, guys. I am going to cover a lot of material as we go through this. It is I highly recommend having a piece of paper handy. I know webinars are multitasking time for a lot of you. So you may hear me try to bring you back into the webinar if I've got something that I think is very valuable to talk about. But the other thing that happens is people think about clients. And the one thing about it, if you hear something on a webinar, you get excited and you're like, oh man, I really need to talk to so-and-so, but you don't write anything down. You and I both know what happens when you're off the webinar. So we're going to go ahead and get started, guys, because your time is valuable, and I want to make sure we get all of this in that we can. You're all speed readers, so there were your disclosures. On the invitation, one last thing that you guys got, there were about 8 items on here that we're discussing. Is it a trick or is it a treat? So I'm going to make sure to try to address every one of those as we go through the presentation to tell you whether it's a trick or a treat. So starting with the company, I always start here, guys, especially when you're in this long-term care conversation. We all know the numbers in regards to how many companies used to be in the traditional long-term care insurance market and how many have dropped out, how many we see on a monthly basis continuing to drop out in regards to the traditional long-term care world. So ratings and company stability is a big one. So as you guys can see, AM Best rating, we're an A+, S&P, we're a AA-. We just had those ratings reaffirmed. Our Comdex score is a 95. So one of your trick or treat questions was A+ ratings, 95 Comdex, trick or treat. It is absolutely a treat. Those are our financials. One of the other things is we are also a mutual company, not a stock company. Now, to a lot of people that may not mean a whole lot, but I come from a carrier that was a stock company, and we were digging in the couch cushions every single quarter trying to make sure our stockholders were happy. Coming to a mutual company, that's not something we have to do. We're able to invest longer term, ride out certain waves because we're a mutual company investing for our policyholders, not necessarily for our stockholders to see a return every single quarter. And one last thing on this, guys, that I would keep in mind, so if you're taking notes, I know a lot of times with your clients, this type of stuff doesn't always ring home. They know A is good and 95 is high, but they don't necessarily know what that means. If you want to tell a story, there in 2008, your clients know that that was a rough time for everybody, including financial institutions. They would not probably be surprised to find out that there were 29 insurance carriers that were financially downgraded in 2008. Not a big surprise. What they might be surprised to find out is that the carrier you're going to talk to them about, One America, was actually financially upgraded in 2008. That tells a good story about the company that you're representing. Now, I'm not going to spend a lot of time on this, guys, because this is stuff you guys have probably seen, heard, and been beat to death on. But there's a couple of points on this screen that I really want to point out. One is you got to think about the cost of care in an annual basis. I mean, I know a lot of times we talk about daily benefits and the monthly and everything else, but when you're talking about clients that are planning on a fixed income to retire on, they're looking at an annual number, right? They're looking at a number that says, well, for me to retire comfortably, maintain my standard of living, I at least $90,000 a year. So I do all this planning while I'm working to figure out how I can get to that $90,000 a year, right? So when you think about care, you've got to start thinking about, okay, if I need care, the average cost for full-blown care at this rate is almost $90,000. Taxes are going to go up, inflation's going to go up. So you got to think about those things on that basis. One other thing here is the baby boomers, guys, and we're going to talk about this a little more. But everybody on this call, I'm willing to bet if we were in a room together and I said that 10,000 people a day are turning what age, everybody would say 65. We've been saying that for 5 years, guys. That means there's 10,000 people a day turning 70. That means there's 10,000 people a day affected by required minimum distributions, and that's for the next 18 years. People looking for a way to leverage money, and we've got some options to show you how to do that. Now, we all seen the statistics and everything else, men, women, and Alzheimer's, which is a big one, the 8 years average. There was actually a great article in USA Today that talked about if you have $730,000 set aside for care, it might be okay, which most of our clients don't have. And one thing you'll hear me say throughout this entire presentation, if your clients don't allocate some money for care, they are allocating 100% of every dollar and asset they have for care. Guys, you'll hear me say that a lot throughout this presentation, but it is 100% true. Now, there is a statistic that a lot of people like to use when talking about care from the U.S. Department of Health and Human Services of the individuals over 65, that there's a 70% likelihood they'll need some form of care, not flat on your back in a nursing home, right? That's what most people think about. This is help with some assisted, getting in and out of bed or getting dressed or some dementia, right? 70% chance individuals over 65. Now, that tells a good story. So if you're multitasking, come back, guys, because here's a quick yellow pad napkin sales idea that you can do with a married couple. So even if this isn't something that you are primarily focusing on, what a way to sit down with a client and say, look, you guys know the statistic for individuals over 65, 70-30. But in a married couple, what that means is if you've got a married couple over the age of 65, that means there's almost a 50% chance that both of you are going to need some form of care, right? 21% chance that she won't, he will, and vice versa, and only a 9% chance that neither one of you is going to need some form of care. Now, I know there's a lot of information on here, Mr. and Mrs. Smith, but the reality of these numbers that in a married couple of individuals over the age of 65, there is a 91% likelihood that one of you is going to need some form of care, right? And that is an astounding statistic in a married couple. So when you think about that, that's you've got your people that really this stuff resonates with, and then there's, when you present this though, you got to present it in a way to say, look, now the statistics are high, probability's high, but you know what, you may be that lucky 9%. It may never happen to you, but if it did, how would that affect your family? You know, if something did happen, how would that affect your spouse, your children, the family? Guys, most everybody on this call, I'm willing to bet. I'm almost 40, and I've got a ton of experience with all this myself. I'm willing to bet everybody on this call either knows someone or has personal experience of how something like this has affected a family. Use those stories and think about that when you're talking to your clients. And even if your client gets to this point, you say, you know what, you're probably right. You're probably never going to need care. But if you did, who's going to pay for it, right? And a lot of people say the government. Well, remember that line I gave you. And again, if you're multitasking, write this down. If you don't allocate some money for care, you're allocating 100% of every dollar and asset you have for care. Because when people think the government's going to take care of them, that's what they got to spin through first to get the government to pay for them. Okay? So ask them these questions. Don't tell them they're going to have it. Say, look, statistically, the odds are high. But you know what? It probably won't happen to you. But if it did, where do we go from there? So here's another sales idea, guys. So we've talked about the need. I want you guys, this is a sales idea to introduce the concept, right? Because we're talking about, this is where we get into a little bit of the trick or treat, because a lot of people are confused about what options are available. Now, if there's anybody on the call under 30, this is not a hashtag. This is a game called tic-tac-toe, and you can play this with your clients, where you can say, look, I know in the past you've thought to protect yourself, you've had to do it with a traditional long-term care insurance policy, or you were just going to self-fund. Now, the people, the whopping 8-9% that have it, that own a traditional long-term care policy, bought it because of the comprehensive coverage, right? They want home health care, assisted living, adult daycare, respite care. They want what they want, when they want it, and how they want it. So they bought those plans to protect themselves. Now, the reason that a lot of people don't buy it, and everybody on the call could answer this for me, is the number one objection is, well, it's expensive. It's a variable expense. You never know what it's going to be the next year. And if I don't use it, then I'm going to lose it, right? The majority of people, that's not going to happen to me, right? So, well, I'm just going to self-fund because if I don't need it, then I get to keep my money. Well, the downside to that, guys, and we all, again, know the story. If you don't talk to people, you'll get tons of stories where you could lose it all if you did, because if you didn't allocate some money, you allocated every dollar of income and every asset you have to get that care, right? If someone needs care, they're going to get it. If someone has Alzheimer's, they're going to get care. It's a matter of who provides it and who pays for it. It's not a matter of if. So the question becomes in this, Mr. and Mrs. Smith, if you could win this game of tic-tac-toe diagonally, if there was a care solution that provided you comprehensive coverage, home health care, assisted living, adult daycare, respite care, all of that stuff, if you did need it, but if you didn't, offered a death benefit to your heirs, offered a cash value if you changed your mind and got to a point where you wanted to just take money out. If we could bridge that gap and give you the best of both worlds, is that something you'd be willing to sit down and discuss? And the question or the response is usually, yeah, if that's possible. And that's where we get into the trick or treat, guys, because it is not possible with all hybrid products, but it is possible with ours. And we're going to talk first about the life insurance. We really only have two products. We have a life insurance policy and we have an annuity. It's a matter of how you fund the policies, okay? So we're going to jump into the life insurance, and hopefully you guys are sticking with me here, because here's another concept that I really want you to think about, is if someone does not have a plan and they're allocating their own money, and this is their portfolio, where are they going to pull money from first? What are they going to use to pay for it? Because remember, if they need care, they're going to get it. It's a matter of who provides it and who pays for it. Most of the time, it comes from the over $11 trillion sitting in conservative accounts, right? CDs, money markets, cash. These are typically people's rainy day funds, right? Have you asked your clients what a rainy day is? If you haven't, incorporate it. Your clients have money sitting in CDs and they say, well, that's my rainy day fund. That's my what if money. Well, what is the what if you're concerned about? What is a rainy day? Because Mr. and Mrs. Smith, if you have $150,000 in a CD and you need care, the bank's going to give you $150,000. If you pass away and your kids go to the bank, they might get $150,000 eventually after it goes through probate. They pay an attorney and wait God knows how long to get the money. So what if I could take that rainy day money from your left pocket and put it in your right pocket? It's still your money. It's still in your pocket. But if you needed care, instead of getting $150,000, you got $300,000. Instead of your kids having to wait, pay an attorney to get the money you wanted to leave them, they now get double that tax-free. Which one of those is a better scenario? And guys, that left pocket, right pocket story resonates with clients because it's still their money and it's a rainy day. So here's our first product. Remember I told you life insurance and no matter how you fund it. So this is our single premium policy. Okay, so if clients have that rainy day money, for example, $150,000 sitting in a CD, this is based on two 64-year-old clients. So back to our list of trick or treats, one of the questions is trick or treat to cover 2 lives with 1 policy. That is absolutely a treat. I can put 2 people on 1 policy, it's a second to die policy, and cover both of their lives. So this is a 64-year-old married couple that had $150,000 in a rainy day fund. It bought them $300,000 of death benefit, which we then, on a monthly basis, they'd get $6,000 per person over 50 months from the life insurance policy. Okay, $6,000 per person. So even though it's a joint policy, if they both needed care at the same time, they would both get $6,000. So the policy would pay out a total of $12,000, and instead of lasting them 50 months, it would last them 25 months. Okay? Now, just like any other product you sell, if you want to improve upon that base policy, you add a rider. We have a rider as well. This continuation of benefits allows them to continue the benefits from the base policy for the rest of their lives, no matter how long they need care. And guys, I know you've seen the statistics, but I know everybody on this call knows a man who's needed care for more than 2.2 years, not in a facility, right? Care usually starts at home. So I'm saying needed care for more than 2.2 years. A woman that's needed care more than 3.7. So in Alzheimer's, guys, the longest I've heard is 25 years someone had received care. I've heard of 3 people under the age of 50 diagnosed with Alzheimer's. One of them was 29. He's going to need care for a long time. So just like when people do income planning to have an income they can outlive, wouldn't they like an income protection policy if they need care to guarantee the rest of their lives as well? Now we're going to dispel a whole bunch of myths and trick or treats right here. So guys, the $1,486 annually. This rider can be paid for on an annual basis, 10 pay, 20 pay, or single pay. In this particular scenario, on an annual basis, these two 64-year-old clients are paying under $1,500 a year, and it's guaranteed. This isn't a by current company practice, we're not going to raise rates. This is a non-cancelable policy. We contractually cannot increase the rates on that rider. So that $1,500 is locked in. Can't change, can't go up. Okay? We can't modify anything about it once they buy the policy. So 1, lifetime benefits, trick or treat. Absolutely a treat, guys. Lifetime benefits are available on this product. Okay? Now, can it be paid for annually? Single pay? Absolutely. This is a treat. Clients have options. Also, because the rider is true long-term care insurance on a hybrid product, and this is one area where we are so different than any other hybrid out there, our rider is true long-term care insurance. It's a separate policy altogether. So that $1,486, depending on the client's age and adjustable gross income, can be deductible, right? That's normally something you only see on long-term care insurance. This is long-term care insurance. Those premiums absolutely can be deductible up to the guidelines. Here's the other thing. That $1,486, 64-year-old clients may still be working. Remember, traditional long-term care insurance is a true medical expense. So they can use money out of their HSA accounts to pay for this rider, just like they would with traditional long-term care insurance. So, can you use HSA funds to pay premiums, trick or treat? Absolutely a treat. Guys, here's the thing you got to think about. The $150,000, $11 trillion sitting there, clients already have that money. You're literally just repositioning it from their left pocket to the right pocket. So if I've lost you and you started multitasking, let me ask you this one question. If I got on this webinar and said, look, I have a traditional long-term care insurance policy that you can pay for annually, 10 pay, 20 pay, or single pay. It's going to create lifetime benefits. It's deductible. You can use HSA money to pay for it. And for two 64-year-olds, it's only $1,500 a year. Guaranteed never to go up, true fixed expense. If I sold you that traditional long-term care insurance policy, how many of those could you sell? every day and twice on Sunday, guys, and that's exactly what's in front of you right now. That rider is true long-term care insurance, and the $150,000 is money they already had for rainy day. It's just a matter of starting to talk to your clients about it. Now, here's the scenario where these clients said, you know what, I don't want to pay annually. I just want to pay for it and be done, right? Paid up long-term care insurance used to be a thing of the past, not anymore. It's available right here on this policy. Lifetime benefits used to be a thing of the past with traditional long-term care insurance. It's available for you right now, today in this policy, guys. These clients said, you know what, instead of doing that, I'm going to split the money up. Put $128 in the policy, pay for it, lump sum. Notice they're not getting $6,000 per person, so they're not getting $72,000 a year, but they're getting $60,000 a year, tax-free for care, home health care, assisted living, adult daycare, respite care. It is true long-term care insurance triggered by 2 of 6 ADLs or a cognitive impairment, and they can start receiving benefits from this tax-free. So the clients have options to be able to have a paid-up policy as well. Here's where we're also different from a lot of hybrids, guys. When you look at hybrids, well, even in the traditional long-term care insurance space, you're pretty limited on what you can do. You can get 5 years, 6 years, 8 years, kind of is what it is. With our policy in the hybrid world, instead of, they all draw down the life insurance, right? They all draw down the death benefit for care. It's, if you're living and need it, that's when you want it. Ours says, look, not every client has a bunch of money, right? So if they have a limited amount, maybe instead of drawing down 2% of the death benefit, we draw down 3% or 4%, right? So I can create a higher monthly care benefit with a lower death benefit. Now, guys, we don't win in every situation. I'm not saying we're the only product you need to be selling. What I'm saying is it needs to be looked at, especially on a joint basis. I personally always run, and you'll see some examples of 25 months and the lifetime rider, because one, I get a bigger benefit up front, and I'm into the company's pocket with the rider quicker. And there is an automatic waiver of premium on the rider. So if I'm paying for the rider on an annual basis, once I've exhausted the death benefit, the cost of that rider goes away. There's no more out of pocket. I'm just receiving benefits. So there's flexibility to customize this product as well that's not available in a lot of other hybrid products that you see out there. Now, guys, I talked about the boomers, so I want to give you a concept here. So if you've wandered off, come back. These are some numbers people don't really think about. Is the first wave of boomer was born in 46, 3.4 million of them, average retirement account around 136, meaning the average RMD is around 4,000. That means over the next year, we're going to see $16 billion in required minimum distributions. Now, let's say half of them need it for income, half of them want to play with it. That's leaving $4 billion over the next year that people are trying to figure out a way to leverage, right? Everybody that's receiving RMDs doesn't need them for income. But at 70 years old, they're trying to figure out how to leverage because it shouldn't be in the stock market. They're not earning a lot at the bank. How do I leverage that? And again, do they have a care plan? Because if they don't, every dollar is going to be allocated for care, every asset. And guys, this isn't just a problem for the next year. This is a compounding problem for the next 18 years, right? Because those boomers born in 46 are still going to have to pay 2017, 2018, 2019. That money's still coming out. This is a compounding problem that if you've got clients that are either at an age taking RMDs or getting close, looking for a way to leverage that money, here's a way to think about that. What if, and I just did this the other day for a 72-year-old female, she had $150,000 in an IRA that she didn't need for income. She was going to have to start taking her, or she was taking her RMDs from other places. So we put it into a 20-pay SPIA to say, okay, how much would a 20-pay SPIA pay out? And in this particular example, just a little under $9,500. So then with that $150,000 or the $9,000 over 20 years, we did a 20-pay policy because we have a policy that you can pay for annually or a 10 to 20 pay. And then we put the other money into the rider for 20 years, remember, because I can pay up the rider in 20 years. So this created a $4,500 monthly benefit, but the reality is she got almost $55,000 a year tax-free for care using her qualified money. Now, guys, think about this. If she did not put this plan in place and she had a care event and started to have to withdraw money to pay for that care, she would be pulling out more money because she'd have to pay the taxes when she did it. And again, she's got to pay the taxes on the $9,400 when it comes out annually for 20 years. But then that $150,000 would have been gone in less than 2 years. But I've created a benefit by doing it this way where she has lifetime tax-free benefits of almost $55,000 a year, and it's paid up after 20 years. So again, I know this is a lot to take in, guys, but what I want you to think about is if someone is getting to the age where a lot of money they have is in qualified funds, that they're looking for a way to leverage it, we have ideas and concepts that you can get from the folks at Premier to say, how would one of these hybrids incorporate to be able to use qualified money into a product like this? Here's an example of just two 55-year-old clients with that same product, guys. This is our continual pay policy that says, okay, if I want to pay annually because I want it to be a budget item, this isn't usually where people have thought about hybrid products, right? Most hybrid products are single premium up to maybe a 10-pay maximum. We have the ability to do annual pay, 10 to 20 pay. Okay, so two 55-year-olds, the base policy, that $2,550 is locked in, can't go up. The $1,400 for the rider locked in, can't go up. So they're under $4,000 a year in cost. That's creating them $60,000 per person tax-free for care. And remember that $1,433 can be paid for with an HSA. So when you're thinking about a budget item, is think about, okay, now you may think this $4,900 is a lot of money, but what about if the $1,433 is paid for by through your HSA? Then we're really looking at this $2,550, right? So there's ways to look at this, guys, to create lifetime benefits as a budget item. Now, the reason that's important, these folks are 55. I'm only 39. My wife's 37. We're looking at buying this policy as well. Reason being is, again, remember where I told you I've seen a lot of this. So just so you know a little bit about where my passion for this comes from, let's see, I'm a cancer survivor. I have physically cared for a parent, financially cared for a parent, lost a parent when I was 58. I've lost a child, been divorced. I've had all that happen by the time I was 33 years old, guys. So the one thing, when people say it won't happen to me, I tend to giggle a little bit when I've had more life experience than most people should ever have in one lifetime. But in looking at this, for $1,800, it gets me $200,000 of death benefit. Now, at this age, could I get more death benefit for $1,800 a year? Absolutely. But I'm drawing down my death benefit at 4%, so it's giving me $8,000 for me and my wife. That's $96,000 a year, tax-free for care, and the rider costs me $2,778, so I'm just a little over $4,000 to create $180,000 of tax-free income for care for me and my wife. Now, guys, I work for an incredible company. Most people working in large companies, they are advocating for healthy employees. So my company will also contribute to my HSA if I get annual checkups and flu shots and all this other stuff. So for me, not only do I get to use HSA money to pay for that rider, my company is putting money into my HSA, so it's literally no money out of my pocket. Well, not as much money out of my pocket for the rider. So this is a very budgetable item for me as a young person to be able to have this kind of protection for me and my 3 daughters. There is also, guys, if you've got people that gift money, there's a 25-year age gap for insurable interest on this. So you've got younger people, you've got people that are getting ready to take RMDs, you've got people with rainy day money and lump sums. Now you've got people that are, if they're looking to gift money, there's a 25-year age gap. So this is an example of me and my mother, because my dad passed away, mom spent everything. So now if she needs care, it's going to fall on me one way or the other. So if I purchase this plan, it brings her age down to about 53 because we take joint age in the policy, and it creates more benefit for her. And if she passes away, there's benefit left for me to add to the other 8,000. So I call this the gift of care, guys. Is a lot of people are looking to gift money to their kids, but there's limitations, all the taxes and stuff that they got to look at. Why not give the gift of care? Why not put a plan in place for your clients to protect themselves from becoming a burden on their children, but also protect their children from becoming a burden on their grandchildren. You want to talk about a gift? What better gift could you give than to provide that kind of protection for 3 generations? So think about that as well when you're talking about it. And here's one way, guys, and again, here's an analogy that I like to use, and so far it's proven pretty true. It's renting versus owning. Traditional long-term care insurance is a lot like renting. You may have lower monthly payments. You're going to pay forever. Your rent can go up every year, right? If you remember renting, you have no equity. You got nothing to leave behind, right? That's traditional long-term care insurance. This one, your payments might be a little higher, but you can make them fixed, right? You can pay up 10, 20 years. It's locked in. It cannot go up. It's non-cancelable. You're building cash value. You're building life insurance to leave to your kids if you don't use it. Guys, the cash value on my policy after 12 years, my cash value on my policy is the same as the premiums I put in. I'm literally losing nothing by purchasing that policy, and I am gaining everything. So it's renting versus owning when you look at traditional compared to having something like the Asset Care 4 that's tangible. And guys, this isn't new. This product's been out since '93. All right, I'm going to run through the annuities pretty quick because here's something the policies work the same, guys, but if you remember why annuities were sold, there's $60 billion in non-qualified annuities out there. And if you remember why annuities were sold 10 or 15 years ago, it wasn't these income riders, it was CD alternatives, right? It was why pay taxes when you can defer taxes in an annuity savings type account, right? So now there's over $60 billion sitting in non-qualified annuities, where the majority of it is going to end up in the hands of a beneficiary, because when clients need money for rainy days, it's the last place they go because they don't want to pay taxes on it. So the government wrote into law in 2006, which took effect in 2010, in the Pension Protection Act, if you transfer a non-qualified annuity to a PPA-compliant annuity, and that money comes out for care, it will come out 100% tax-free. Guys, you can now take clients with non-qualified annuities not being used for income. Had a case the other day that literally all we said to the client was, you're not using this for income. If there was a way to eliminate the tax burden of that $150,000 of growth you've got in there and protect your income for fixed and discretionary expenses as well as your assets, is that something you'd be willing to sit down and talk about? She absolutely jumped on board and purchased one of our policies because it was just another rainy day fund. And it works the same way, guys. We have one that is a fixed annuity with a lifetime optional rider. Okay, this particular example, instead of putting all 125 into the annuity, we put 102 into the base, and then we paid for the rider in a lump sum. So this 81-year-old female with $125,000 is getting $36,000 tax-free, right? When you think of pulling money out of non-qualified annuities, tax-free is not usually the first thing people think about. But because of this Pension Protection Act, they have the ability to do that if the money comes out for care. Okay, so this is a way to add lifetime benefits, get them out tax-free, and it still is based on 2 of 6 ADLs or a cognitive impairment will trigger the benefits to come out and pay for the client's care. Okay, so we have a fixed annuity with a lifetime optional rider. We have a fixed annuity with the rider built in. This is our most popular product because it works a lot like income rider products that clients are selling today. Is you put in the $100,000, the cost of the rider automatically comes out, so there's no out-of-pocket expense, and then they choose the leveraging that they want. So if you're $100,000 with this 65-year-old female, do you want a pool of $250, $400, or $550? Right? Now, most people will say, well, Jay, why would I ever not choose $550? My first response is, good question. Second response is because sometimes based on the age of the client, the actual annuity value, the accumulated value, can go down, right? So in some instances, $100,000 after 10 years might be $90,000. But here's the thing I remind clients is you buy these for care, right? You don't buy any of our products to get rich. You buy them to prevent going broke because of a care need. And even if that $100,000 drops to $90,000, the total pool of benefits is still 5.5 times of $90,000. So there's still almost $500,000 of money for care. So again, this is an easy way to go, an illustration. Have the folks at Premier look at this. If you've got clients, so again, if you're taking notes to say where does this pertain, clients with non-qualified annuities not being used for income, I need to look at a way to take that money out and protect their fixed and discretionary income and their assets, and this is a great place to go. We also have an index annuity where you can offer lifetime benefits. And guys, I highly recommend this product. People always say, oh my gosh, it's an index annuity, it's super complicated. Don't use the indexing. Put 100% of the money in the fixed account. And you can still add lifetime benefits, but you also get multipliers. So unlike the other one we have that's a fixed annuity with the optional lifetime benefit, this one, you can put all the money in the fixed account with the optional lifetime benefit, but when the time comes, depending on how long they've been in the policy, you can see this one, if they were in there for 20 years, we look at the greater of the initial premium at 1.5 times, or we look at the accumulated value at 1.15. And the client will get the greater of those two tax-free for care. So there's some leveraging in there to ensure that the clients get more bang for their buck. And there's a website you guys can go to if you'd like to learn more about that. Anything else, I highly recommend calling the folks at Premier first to answer some questions for a little more guidance on that. Now, everybody goes to underwriting. This is absolutely a long-term care product, guys. I know in the traditional world things have gotten a little stricter, but you'll notice on this one, stroke after 6 months, single episode can still qualify. We've got insulin-dependent diabetics that own our annuities. So if you've got people that have been declined for traditional long-term care, the folks at Premier have a pre-underwriting form where you can give them the health of why they got declined. Maybe you think it's questionable. They can email that in to us, and within 24 hours, we're going to give them a response that says, all things being equal, right? If anything shows up that wasn't on that sheet, obviously we can't guarantee anything. But if all things being equal, they would be approved for this, this, or this. So there's a way to, again, second option of how to make this webinar that you've taken time out of your day to be worthwhile. Not only those clients with non-qualified money not being used for income, go through your files of traditional long-term care insurance that were declined. Maybe you think it's questionable. Even if it's hybrids, guys, we've got some simplified issue hybrid products where clients have been declined for that product, came to us and got qualified. Okay, so any of your declines. Now, if it's ridiculous, don't send it to them. don't waste their time. If it's questionable, send it to them, and there might be options for those clients. Now, here's one thing I like to tell people, and we'll get personal before I close here. Tall women scare me to death. I'm 6'3". My ex-wife was 4'11". It only lasted 3 years. My current wife is 4'9", and we've been together for 11 years. The reason I tell you that story is because it makes me giggle in regards to our height-weight charts. My wife could weigh 222 pounds and still qualify for our life insurance policy, guys. So the underwriting is very liberal, is the point I'm trying to get at. So this is my contact information. I'm going to bring Kathy back on here, but I really want to reiterate to you guys, I know there was a lot of information, but with a true long-term care rider, they can be deductible. You can use HSA money. We do have lifetime benefits that can be paid up or paid for annually. 2 lives on one policy. If you've got big age gaps, taking the joint age can get more bang for your buck for both of those clients. And looking at non-qualified money, not used for income, looking at a budgeted item because we have lifetime pay with lifetime benefits. There's your declines for traditional long-term care insurance, guys. Hopefully, there's one thing you've gotten out of this webinar that will add to your business and hopefully dispel some of the myths that you've heard about hybrid products. So thank you for the time. I know I went a little long. Kathy, I'm going to go ahead and turn it over to you.
Hey, thanks, Jay. This was a great webinar. I appreciate everything that you went over on here and hit all the main topics that we wanted to hit on. Sounds like everything you talked about today is perfect treat for your clients. I didn't hear any tricks in there, unless you have anything up your sleeve. I don't know. But please, if you have any questions, give Premier a call. Our number is 800-365-8208. Ask for a hybrid life marketer. One of us will can help you answer any questions, get you the pre-qualification form, get you contracted and get you set up for that. Anything else that you may have questions for, we can help you run quotes and get you going on this. I don't see, well, I had one question that was asked during the whole thing, but I think you answered this, but I'll have you do this again. Is this tax qualified to deduct for health or company benefits? And I believe you answered yes on that. So on the COB writer, is that correct?
Right, based on their age and adjusted gross income, and we've actually got, and the folks at Premier, we've got a tax guide in regards to our products because it is a little different with the writer being traditional long-term care, so it answers a lot of those tax questions. And we do also have a page, a one-page PDF in regards to deductibility as well, that if you contact the folks at Premier, they can get you that information.
Wonderful. Yeah, give us a call if you'd like to have that information. We do have this webinar will be recorded, so if you would like to listen to this again, please let us know as well. We will be trying to reach out to each and every one of you that were on this to discuss to see what else you have, but if you have questions right away, please don't hesitate to give us a call. Thanks, Jay, for everything you do for us. As always, I appreciate it, and everybody have a great day. Take care.
Thanks, Kathy. You too.